What if I told you the system your entire retirement is built on is fundamentally changing? What if the very dollars you've saved for decades are being quietly devalued by the same institutions that are supposed to protect them? This isn't some far off abstract economic theory. This is happening right now. As we head into the final stretch of the year, all eyes are on the Federal Reserve. There's a heated debate among market watchers about whether the era of fighting inflation is ending, not because the battle is won, but because the medicine has become too painful for the economy to take. Many are pointing to the beginning of December as a symbolic turning point, a moment the Fed may be forced to pivot away from its tightening policy. A switch might be about to flip. The government's money printer, after a brief pause, could be warming up again. This isn't just a news headline, it's a direct and imminent threat to the value of your life savings. While most people will stand by and watch their hard earned purchasing power silently evaporate, a select few are quietly preparing. They understand that the financial landscape is being rewritten. In this video, we're going to pull back the curtain on this whole process. I'll show you in practical step-by-step detail how this devaluation works and what it means for your 401k, your IRA, and your pension. More importantly, I'll reveal the powerful steps you can take to safeguard your future with an asset designed for this exact scenario: Bitcoin. And for those of you ready to take action, I'll name three specific providers that already allow you to add Bitcoin to your retirement accounts, securing your wealth for the long term. Stay with me because what you learn today could be the most important financial decision you make for your retirement. To really get the danger facing your retirement, you first need to understand the game being played by central banks. For the past couple of years, you've heard one phrase repeated in the financial news: the Federal Reserve is fighting inflation. They've been doing this mainly by raising interest rates and through something called quantitative tightening, or QT. Let's break that down. Quantitative tightening sounds complicated, but the idea is simple. Imagine the economy is a giant hot air balloon. During the 2020 crisis, the Fed pumped a massive amount of hot air money into the balloon to keep it from crashing. This was called quantitative easing, or QE. They did this by buying up assets like government bonds, which flooded the financial system with trillions of new dollars. Now, QT is the reverse. The Fed has been trying to slowly let some of that air out of the balloon to stop it from overheating, their metaphor for inflation. They've been letting those bonds mature without reinvesting the money, effectively pulling dollars out of the system. On the surface, this seemed to work for a bit. But here's the critical problem: the dirty secret of modern monetary policy. The system is now addicted to that hot air. Our economy has become so dependent on low interest rates and a constant flow of new money that it struggles to function without it. The process of QT, of letting the air out, is causing immense stress. We're seeing signs of it everywhere. Liquidity in key financial markets is drying up. Economic growth is sputtering. The government itself is staring down a colossal debt that gets more expensive to pay off every time interest rates rise. This is why so much speculation about an imminent pivot exists. The Federal Reserve is backed into a corner. They face a choice between two terrible options: keep tightening and risk a severe recession, or pivot back to easing and risk another wave of inflation. History shows us time and again which path they usually choose. They will almost always opt to save the system in the short term, and that means turning the money printer back on. This isn't just conspiracy. Recent analysis points to this conclusion. For instance, there's growing discussion among financial analysts that the Fed may soon announce an end to its quantitative tightening program, citing drying liquidity in overnight markets. Some even suggest a full return to quantitative easing, or QE, could be on the table as soon as 2026. The exact date isn't the point, the trend is. The tightening cycle appears to be on its last legs, and an easing cycle is on the horizon. So, what exactly is this money printer? Let's look closer at quantitative easing. When the government needs to fund its spending, it issues bonds. In a normal world, people like you, me, or a pension fund would buy those bonds. But in the world of QE, the Federal Reserve just creates new digital dollars out of thin air to buy those bonds itself. It's a closed loop. The government spends, and the Fed prints the money to pay for it. This process has hit staggering levels. In the single year of 2020, the M2 money supply, a broad measure of money in circulation, shot up by an almost unbelievable 25%. Think about that. In 1 year, the amount of money in the system grew by a quarter. This wasn't because the country got 25% more productive or created 25% more stuff. It was a purely monetary event. New digital dollars were willed into existence, and every single one of those new dollars dilutes the value of all the dollars already in your bank account. This leads us to the most insidious threat to your retirement, inflation, but not the inflation you hear about on the news. The government's official number, the Consumer Price Index, or CPI, is a carefully constructed metric. For the 12 months ending in September 2025, the official CPI was reported to be 3.0%. While that's an improvement from the highs we saw, it's still a big deal. At 3% inflation, the money you've saved loses half of its purchasing power in about 24 years. If you're 40 today, by the time you're 64 and ready to retire, your savings will only buy half of what they do now. But a lot of people feel that official number doesn't tell the whole story. Have your grocery bills, insurance premiums, or housing costs only gone up 3% in the last year? For most, the answer is a big fat no. The official CPI calculation has been changed many times over the decades. It uses methods like substitution, where if steak gets too expensive, they assume you'll just buy hamburger, and hedonic adjustments, where they decide a new iPhone is better than the old one, so they adjust the price increase downward. Whether you think the real rate of inflation is 5%, 8%, or even higher, the fundamental truth is undeniable. Your money is losing value. Inflation is a silent tax. It's a wealth transfer from savers to debtors. And who is the biggest debtor in the world? The government. They get to pay back their monumental debts with cheaper, devalued dollars. And who's on the other side of that trade? You are, the retiree, the person who did everything right, worked hard, saved diligently, and put off gratification for decades, is the one left holding a bag of currency that buys less and less each year. For generations, the standard advice was the 60-40 portfolio: 60% stocks for growth, 40% bonds for safety. This was the bedrock of financial planning, but the very monetary policies we've been talking about are challenging this model like never before. Let's look at the safe part of your portfolio: bonds. A bond is basically a loan. You lend money to a government or corporation, and they promise to pay you back with interest. For decades, this was a no-brainer. But what happens in a world of 3% official inflation? If you buy a 10-year treasury bond that yields 4%, your real return after inflation is just 1%. But if you believe, as many do, that true inflation is higher, your real return is actually negative. You are literally paying the government for the privilege of lending them your money. Bonds are no longer a risk-free asset. For many, they've become a return-free risk. You take on all the risk that interest rates will rise and crush the value of your bonds, all for a return that doesn't even keep up with the devaluation of your currency. So, what about stocks? The 60% of your portfolio meant for growth. Surely stocks are the answer? Well, it's complicated. In the short term, printing money can definitely pump up stock prices. All that new cash has to go somewhere, and a lot of it finds its way into the stock market. This creates a wealth effect that makes people feel richer, even if the real economy isn't any stronger. But this is a dangerous game. It creates bubbles. We're no longer investing based on a company's solid fundamentals. We're often just speculating on what the Federal Reserve will do next. Will they print more money or not? That's not investing, it's gambling on monetary policy. And even if your stock portfolio jumps 10% in a year, if the money supply grew by 15% and your real world costs have soared, have you actually gained any purchasing power, or are you just running faster to stay in the same place? This is the trap millions of retirees are now in. The traditional playbook is failing. The very foundation of retirement planning, saving in dollars and investing in stocks and bonds, is being eroded. You're being forced to take on more and more risk just to try and outrun the debasement of your currency, while the safe part of your portfolio guarantees a loss. This is not a sustainable path. This is a system at its breaking point. So, what can you do? As you stand here watching these massive economic forces converge, it's easy to feel powerless, like you're a small boat in a hurricane tossed around by waves of monetary policy you can't control. But this is the moment where feeling powerless is a choice, not a destiny. You're at a fork in the road. Down one path is the status quo. It's the path of doing nothing and just hoping for the best. It's trusting that the same system that created this mess will magically fix it without hurting your savings. It's watching your 401k go up and down, celebrating the green days and despairing on the red, all while the real value, the purchasing power of your nest egg, is silently being siphoned away year after year. This is the path of gradual impoverishment, and it's the one most people will unfortunately take. But there is another path. This path starts with understanding that the rules of the game have changed. It requires you to look beyond the traditional financial system for an asset that operates outside of its control. an asset that can't be created from thin air, an asset that can't be devalued by a committee. You need a lifeboat for your wealth, a fortress to protect your purchasing power from the flood of currency that's coming. This path demands a shift in perspective. It means recognizing that the dollar is no longer a reliable store of value over the long haul. It means searching for something that is. For centuries, that something was gold, physical, scarce, and universally recognized. And while gold still has its place, a new asset has emerged that takes the best properties of gold and upgrades them for our digital world. This is the path of taking control. It's the path of allocating a small, strategic piece of your retirement savings into an asset designed to be the ultimate protector of wealth in an era of monetary chaos. That asset is Bitcoin. Before I reveal exactly why Bitcoin is the solution and show you the practical steps to add it to your retirement plan, I want to ask a quick favor. If you're getting value from this breakdown, if your eyes are being opened to the risks hiding in plain sight, please take 1 second to hit that subscribe button and turn on notifications. My goal on this channel is to give you the information you need to navigate these turbulent times and secure your financial future. Subscribing is the best way to make sure you don't miss any crucial updates. Your support lets me keep making content like this. Thank you. Now, let's get into the solution. To understand why Bitcoin is such a powerful solution, you have to understand what it is and, more importantly, what it isn't. Bitcoin isn't a company. It doesn't have a CEO. It's not controlled by any single government or bank. At its core, Bitcoin is simply a software protocol, a set of rules for a new kind of money. And the most important rule is its supply. This is the key. Unlike the US dollar, the euro, or any other government currency, Bitcoin is absolutely, verifiably scarce. There will only ever be 21 million Bitcoin. This number isn't a suggestion. It's written into the code and enforced by a global decentralized network of computers. It cannot be changed. No committee can vote to create more Bitcoin to bail out a failing system. No central banker can press a button to increase the supply. Its scarcity is its most profound feature. This is why the best analogy for Bitcoin is digital gold. For thousands of years, people used gold as a store of value because it's hard to find and expensive to mine. Its supply grows very slowly, maybe 1 to 2% a year. This scarcity is what allowed it to preserve wealth across centuries through the rise and fall of countless empires and their fiat currencies. Bitcoin takes this concept and supercharges it. It's a weightless, timeless, and borderless store of value. You can send millions of dollars worth across the globe in minutes for a fraction of the cost of a bank wire with no one's permission. But its killer feature for a retiree is its perfect, predictable, and unchangeable monetary policy. We know exactly how many Bitcoin exist today, and we know exactly how many will be created tomorrow. This programmatic scarcity makes it the ultimate hedge against the programmatic and seemingly infinite printing of government currencies. When the Federal Reserve creates trillions of new dollars, they aren't creating new wealth. They are simply redistributing existing wealth. Each new dollar dilutes the purchasing power of every other dollar. Bitcoin is the antidote. It is an anchor of certainty in a sea of monetary madness. Now, let's address the elephant in the room. Volatility. The price swings can be dramatic. We've seen breathtaking rallies and gut-wrenching crashes. Research has shown that Bitcoin's volatility can be 4 times greater than the S&P 500. This is not an asset for the faint of heart, and it is definitely not something you should put your entire life savings into. That would be reckless. But you have to understand the nature of this volatility. Bitcoin is a new monetary asset in the process of being adopted by the world. It's going through a price discovery phase. It's like watching a tiny startup trying to compete with the world's largest monopolies. The ride will be bumpy, but that volatility also reflects its potential. This is why the strategy for including Bitcoin in a retirement portfolio isn't to go all in. The smart move is to make a small, prudent allocation. This is often called an Hort asymmetric bet, an investment where the potential upside is many, many times greater than the potential downside. Let's put this in context. Imagine you allocate a small 5% position to Bitcoin. What's the worst case scenario? If Bitcoin were to go to zero, an outcome that gets less likely every day as major institutions adopt it, you would lose 5% of your portfolio. That would be painful, but for a diversified portfolio, it wouldn't be a catastrophic, life-altering event. Now, what's the upside? If Bitcoin continues on its adoption curve, if it keeps serving as a hedge against currency devaluation, its value could increase by 5 times, 10 times, or even more from here. In that scenario, that small 5% allocation could have a profoundly positive impact on your entire nest egg. It could be the engine that allows you to not just keep pace with inflation, but dramatically outpace it. A small, calculated risk for a potentially massive reward. Another big concern is regulation. You might hear people say the government will just ban it. While this was a legitimate risk in the early days, the landscape has changed dramatically. Bitcoin is now held by public companies, offered by the world's largest financial institutions, and traded as regulated ETFs on the stock market. The regulatory environment is maturing. In a significant shift on May 28th, 2025, the US Department of Labor officially rescinded its 2022 guidance that had warned planned fiduciaries to exercise extreme care with cryptocurrency. The new stance is one of neutrality, stating that fiduciaries must simply apply the standard duties of prudence and loyalty, just as they would with any other asset. This landmark change removed a major roadblock and signaled that the regulatory tide is turning toward acceptance, not prohibition. The government is moving to regulate Bitcoin, not to ban it. So, how do you practically and safely add this asset to your retirement plan? It comes down to two principles: your allocation strategy and your investment method. First, allocation. As we've discussed, this isn't about betting the farm. For most people, a strategic allocation of 1% to 5% of your total portfolio is a prudent start. Think of it as portfolio insurance against the debasement of the very currency it's all denominated in. Second, the investment method. Trying to time the market with a volatile asset like Bitcoin is a fool's errand. The smart, disciplined approach for a long term investor is dollar cost averaging, or DCA. It's simple. You invest a fixed amount of money at regular intervals, no matter the price. For example, you might allocate $200 from every paycheck into Bitcoin. When the price is high, your $200 buys less. When the price is low, that same $200 buys much more. Over time, this smooths out the volatility and turns it into your friend. Finally, let's touch on custody. When you invest in Bitcoin through a retirement plan, you aren't holding the private keys yourself. Your Bitcoin is held by a qualified custodian, like a regulated trust company or bank, that is legally responsible for safeguarding your assets. This adds a layer of safety and simplicity that's appropriate for retirement funds. For a long time, holding Bitcoin in a traditional retirement account was just a dream, but the infrastructure has been built and the on ramps are now open. Here are three major categories of providers leading the way. First, and most significantly, is the institutional giant Fidelity Investments. This isn't some small startup. Fidelity is one of the largest asset managers on the planet. In a move that sent shockwaves through the industry, Fidelity launched its digital asset account, allowing employers to add a Bitcoin option to their 401k lineup. An employee at a company with this feature can now allocate a portion of their 401k contributions directly into Bitcoin, right alongside their traditional mutual funds. Fidelity's move was a massive vote of confidence. Second, for those who want to use an individual retirement account, or IRA, there's a growing number of specialized crypto IRA custodians. These are companies built specifically to hold cryptocurrency within the legal framework of an IRA. Companies like Alto IRA, iTrust Capital, and Bit IRA fall into this category. These platforms let you open a new IRA or roll over an existing one, and then use those funds to invest directly in crypto. They partner with qualified custodians and major exchanges to ensure assets are securely held. For example, Alto IRA partners with Coinbase, giving users access to over 200 cryptocurrencies in a secure, regulated environment. Third, we have providers focused on the 401k market for small and medium sized businesses. A prime example is Forusol. Forusol is a 401k provider that partnered with Coinbase Institutional to create a crypto window for the plans they manage. This allows employees at participating companies to allocate up to 5% of their portfolio into a curated list of cryptocurrencies. It's an innovative solution that gives people exposure to this asset class directly through their workplace plan. The existence of these providers, from a titan like Fidelity to specialized firms like Alto IRA and innovative platforms like Forusol, is proof that the infrastructure is here. Investing in Bitcoin for retirement is no longer a niche, complicated process. It's becoming a mainstream option. We've covered a tremendous amount of ground. We've looked at the fragile state of a financial system addicted to creating new money and how that poses a direct threat to the purchasing power of your retirement savings. We've seen why the official inflation numbers might not be telling the full story and why the traditional 60-40 portfolio is facing its biggest challenge in a generation. But we didn't end on a note of fear. We ended on empowerment. We've explored the solution, a decentralized, provably scarce asset that operates outside the failing system. We've seen how a small strategic allocation to Bitcoin, made through a disciplined dollar cost averaging approach, can act as a powerful insurance policy for your portfolio, an asymmetric bet that protects you from the downside of currency debasement while giving you exposure to incredible upside. Most importantly, we've made it practical. You now know that trusted, regulated providers like Fidelity, Alto IRA, and Forusol have already built the bridges for you to safely add Bitcoin to your 401k and IRA. The path is clear. The choice now is yours. You can stay on the default path and hope the storm passes you by, or you can take control. You can build a lifeboat. You can fortify your financial future against the certainty of currency devaluation. The first step is education, and by watching this video, you've already taken it. The next step is action. Your secure retirement won't be given to you, it's something you must build and defend. If this video has opened your eyes to the new financial reality, continue your journey. Click here to watch my next video on how to set up your first Bitcoin IRA step by step. And if you haven't already, please subscribe for more essential insights to protect and grow your wealth. Finally, I want to hear from you. Leave a comment below. What is your single biggest concern when you think about retirement? Thanks for watching and for taking control of your financial destiny.